Started. Welcome to this morning's webinar on linked benefits, the new way to purchase long-term care, presented by myself, Brian Lysing, and David Corwin from our annuity department. If you're not familiar with financial brokerage already, we're a national marketing organization assisting independent producers all around the country in the areas of life insurance, annuities, and long-term care insurance. And this morning we're going to be speaking about one of the most innovative product lines to come around in the last decade or so, and that is the linked benefit products. They combine either a life insurance contract or an annuity contract with long-term care benefits, and is rapidly becoming consumers' preferred way to purchase long-term care insurance. And we'll go over several things this morning just to let you know. This webinar goes for close to 30 minutes, and we'll discuss the need for long-term care out there, the ways that people have taken care of this in the past, the options that are out there for them, and then we'll go over why a life insurance or an annuity-based contract might make sense for some of your clients out there, and describe the different types and styles that are available, because every carrier seems to have their own take on this out there. So thank everybody for joining us this morning and taking time out of your busy days to do this. So we'll launch into it here. And as I mentioned in the introduction, what we'll be talking about are essentially life insurance or annuity contracts that have some sort of LTC benefit attached to it. Some of you may have sold these already. What I typically find is if somebody has at least a basic familiarity with these products, they're familiar with the single premium type products. Those have been around for a good 15 years, if not more. But there's really a lot more to it than that. Get back to the basic need. We know that the high costs of extended care really pose the greatest threat to our clients' assets as they get older, should they become ill or frail as they age. We know if we all live long enough, these things are just going to happen to us. And that turns into a really big expense for a lot of folks. Now, these numbers are actually a couple of years old, but how many of your clients have this kind of money sitting around that they can sustain pulling out of their retirement plans for a number of years? We've got $81,000 as the median rate for skilled nursing care in a 24-hour facility. That's a nursing home. Assisted living is about half that cost, at nearly $40,000 a year. And if you require home health care, it's also about $40,000 a year. But look at that number. That's the rate for a 40-hour work week. That's 9 to 5, somebody coming into the home. That means somebody else, likely a family member, is taking care of this elderly adult through the evenings and overnight, and certainly on the weekends. If somebody needs care 24/7 in their home, you could probably triple that number right there. How long will your client's assets last at that kind of a withdrawal rate? It won't take very long at all to draw down their retirement accounts. So how have people tackled this in the past? Well, the traditional solution has been to sell the client a long-term care insurance policy. I mean, if we want to insure against long-term care, we get a long-term care insurance policy. It only makes sense, and it still makes sense in some situations. But what we've seen over the past decade or so is that sales have been decreasing for traditional LTC. Premiums have been going up, and a lot of carriers have been exiting the market. In fact, every time a carrier exits the market, carriers have left increase their prices because they don't want all of that extra business. It's now flowing to them, and it's a vicious cycle, and it just makes traditional long-term care unviable in a lot of cases anymore. So because we have all that going on in the traditional LTC market, we've seen an increase in these linked benefit sales, whether they're life insurance-based or annuity-based. In fact, here are the numbers in billions. I mean, back in 2006, 7, and 8, we didn't even have $1 billion in sales. But look what's happened here over time. Just tremendous growth in this area. $2.6 billion went into these linked benefit products just last year. And ask yourself, how much of that $2.6 billion did you write? If you had a good chunk of it, pat yourself on the back. But if you didn't have much of it at all, this is something you want to present to your clients because obviously somebody else is. Now, when I ask people that have sold these products, what was the deciding factor with your client, or why did they finally decide to buy a linked benefit product over maybe buying nothing or over purchasing a traditional LTC plan? And there are two things that always come up in those conversations. One is that the client knows the premium will never change. If you think about a traditional LTC product, it's a health insurance product. Rates can change. Carriers have to change. If they want to change rates, they have to do it for everybody that has that type of policy and that rate class. And they'll do it. If they haven't done it already, it's just a matter of time. With the life or annuity-based products, obviously with annuity, it's a single premium going in. With a life product, it's either a single premium or a recurring premium with a no-lapse guarantee, or maybe it's on a whole life chassis. They have a guarantee their rates will never, ever change. And the other real important guarantee driving the sales is the fact a benefit is going to be paid out no matter what. One of the biggest objections to traditional long-term care has been the client saying, well, wait a minute, what if I pay all these premiums and I never need to use this? I've died and I wasted my money. For some reason, they don't have a problem paying their homeowner's insurance and dying without their house ever having burned down or being blown away in a tornado. They're okay with that. They want to waste that money, no problem. But with long-term care, it becomes an issue for some folks. So we can counter that objection, take it completely off the table. Look, if you never use the LTC benefit, that's fantastic. You died in your sleep. All this money now goes to your heirs. Not a single cent has been wasted. Now, whether we're talking about a life insurance-based product or an annuity-based product, these products all have some key elements in common here. First of all, they're all filed as insurance products, and they all have a benefit that's accelerated for long-term care expenses. Maybe it's the accumulated value in the annuity, or it's the death benefit when we're talking about the life insurance contract. But to keep things really, really simple, all we're doing is accelerating that benefit the client is due at some point in time. We're just allowing them access to it early. And in some cases, we can actually put on a rider, get an extra benefit. But at its most basic level, they're getting something they already have. And the qualifications for benefits, they are common across all the product lines. Same thing you would see with a traditional LTC policy. Client just loses 2 of the 6 activities of daily living, or they suffer severe cognitive impairment such as Alzheimer's. And now I'm going to switch things over here temporarily to David Corwin. He's one of our annuity marketers, and he's going to talk a little more in depth about who would be a good fit for these products, who's in your client files, who do you want to reach out to, and then David, as an annuity expert, is going to go more in depth into the annuity-based products that are available, and I'll catch you on the end talking about the life insurance-based products. So hand it over to David right now.
Thanks, Brian. I appreciate it. Thanks for joining us. Like I said, I've been in annuity marketing for quite a long time, and certainly, as Brian alluded to, agents will ask me a lot of times, who are good candidates for the long-term care hybrid products or the annuity products. And really, it's short of saying anyone. Clients are typically aged 50 to 75. Those are a good candidate, even though some of the products are issued down to 40. But typically what we see a lot of times is the ages of between 50 to 75. Also, clients that are preferring to self-insure for long-term care. Instead of doing a long-term care or a standalone long-term care insurance policy, they just doing they would rather just do, instead of doing self-insure, they'd rather just do the hybrid type of annuity. Or of course, sort of have large amounts of lazy money that are out there that aren't working too well for them. Maybe they're in CDs or money market accounts and things like that. That might be a good opportunity for them to go into one of these type of products. Also, they have concerns about paying ongoing long-term care insurance premiums. Of course, as Brian maybe alluded to, or he'll get to in a little bit, is that we've seen long-term care insurance premiums increase immensely here, on the standalone contracts, of course. And of course, that's getting to that is they're worried about the traditional long-term care rate increases. looking for additional coverage to an existing long-term care insurance plan. So if somebody already had a long-term care insurance plan, getting one of these contracts would actually be a good thing as well. And of course, when we talk about these type of products, there is a liquidity option as well to it. So they can get their money if they needed to. Finding the money, of course, the business market or the individual market. Business market, I mean, we're just trying to give you ideas, different clients to see, because you got to think outside the box here. You have deferred compensation recipients, employees that have maybe bonuses. You have individuals that may have sold a business or maybe even a farm. That's the money that would be accessible for going into one of these contracts. Individual market, again, life policyholders with return of premium. So if you've sold them a term insurance contract a while back and now they have that money, that would be a good opportunity for them to go into one of these contracts. Annuity holders is another one. So if you had a highly appreciated annuity contract or just a regular non-qualified annuity contract, you can go into one of these things because you can go into an annuity and not go into life, of course. The lazy money out there. You also have the permanent life holders who no longer have need for the life insurance coverage. If you had individuals that maybe have some 1035 money there or cash value money, that would be a great opportunity for them to and they of course no longer need the coverage, 1035 exchange that into an annuity contract. Types of linked products. Of course, on the annuity side, you have the single premium deferred, as well as a flexible premium deferred. And then on the life side, you have single pay and multi-pay. And of course, Brian will go over that in a minute. But the types of the advantages, I would say, would be, and of course, Brian will talk about the advantages on the life side, but as I was referring to, the clients that own an annuity contract can transfer the funds into the linked product, and as well as the inflation protection. It might be a good opportunity to do that because the inflation protection endorsement is available on there, and also when you run these illustrations, you'll see that a lot of times it's 2 to 3 times the amount going in. So if you picture $100,000 going in and possibly a $300,000 pool of money that's available for long-term care benefits, that's a great situation that you've now put your client into. Underwriting, we'll talk about that a little bit too. As you know, or maybe you don't know, there's a lot less underwriting requirements on these type of contracts. The long-term care, it's sometimes 3 or 4 months to get these things issued. With the linked benefit, there's a lot less scrutiny, if you will, on the underwriting side, so you can get somebody approved where maybe you couldn't get somebody approved in a long-term care or a standalone long-term care insurance contract. In regards to the annuity long-term care hybrids, there's really 2 different types, and they've kind of come in order of this. So I mean, the annuity products, the state life annuity care 1 and 2, those came out a while back. As if you've spent any time in the insurance industry, you'll come to realize that insurance companies are commonly coming up with new products that are maybe more attractive and more beneficial to clients and make themselves seem more marketable. That's where the income riders come into play. But on the income rider side of things, if you see there, we put there no underwriting. Those contracts, there really isn't any underwriting other than the suitability of the contract. You have the indexed annuity, American Equity Lifetime Income Benefit Rider that's available on all of their products. So of course you'd have to pass the suitability, which is common on any indexed annuity sale. Fidelity and Guarantee also came up with one. It's on their protection package on their Prosperity Elite 10 and 14 contract. And Allianz actually came to the market here recently on their 222 product, which, by the way, is their #1 selling, I should say the #1 selling indexed annuity contract in the industry. And then we put more to come because it seems to me that that companies are seeing that other companies are seeing a lot of sales in that, and they'll start offering these things. So I'm sure there's going to be more to come on that. And then, of course, the annuity hybrids, as I alluded to, State Life has a couple of them. Well, actually, they have a few of them on the asset care product too, and I'm sure Brian will talk about that. But the annuity care 1 and 2 are the really ones that I see the most of. They're issued in single and joint life. Usually offer a dollar for dollar benefit. Long-term care fund typically will grow at a higher percentage rate. So I was going to have a slide on here that showed the actual rates. but it's usually about 20 basis points difference. So the long-term care fund is going to grow at about 20% basis points higher than the I call it the liquidity or the cash value of the annuity contract. No medical exams and more liberal underwriting. You'll see that a lot of times where these, they'll get issued where the long-term care insurance contract wouldn't. Option to purchase a rider to extend the benefits for a lifetime. The Annuity Care 2 already has that built in. The continuation of benefits riders are already built into the contract, so you don't have to add it onto it. And then about 3 or 4 months ago, State Life also came out with the first one in the industry called the Indexed Annuity Care. So it's an indexed annuity that actually has long-term care benefits on it. So the optional continuation of benefits rider is of course optional. Brand new. It's brand new to the industry. That's why I wanted to bring it up to you. Possibility of capturing because of the fact that the long-term care fund is tied to an index. Possibility of capturing higher rates of return because it's tied to the index. It also accepts non-qualified as well as qualified money. There's another contract on the asset care side of on State Life that also accepts qualified money, but it's a bit problematic in how you get the money out of it. But again, it accepts IRA money, 9-year surrender period, and as well as 10% penalty-free withdrawals on that contract. So I just brought that up because of the fact that it's brand new to the industry. We have, I've gotten, a couple of different, couple of sales out there possibly, but it's brand new to the industry, and I'd certainly be talking about it. And then income riders. These are, like I said, relatively new to the industry. It's typically what you'll do is you'll have with American Equity, they're kind of, there's a few differences in them, but I'll go over those in a second here. So American Equity has the lifetime income benefit rider that's available on all their index products, and you'll see the no underwriting commonly on these next few slides because that's the high point. There's no underwriting on it. It does offer a 6.5% growth rate for 20 years, and there are fees on these. So you'll see here in a little bit the fees can be close to, you'll see it's almost 1% on a few of these. So the 6.5% for 20 years, the fee is 85 basis points. So for 100 grand or so, you're going to probably pay about 850 or so per year on that. It's going to come out of the contract in some shape or form, of course. A 7% growth rate for 10 years, the fee is 1%. And the main thing, the main feature of these is that it doubles the income. So you could have somebody, 50 years old or whatever, get the contract, and at the age of 60, their income, let's say their income is $7,500 or whatever that amount is, would double, and that actually goes for 5 years. Eligibility of that is you cannot be confined can't be confined at the date of issue. That's sometimes agents will ask that question, and it's almost like a no-brainer. They can't be confined at the time of issue. The eligibility to actually get the double is you can't perform 2 out of the 6 ADLs, and contract has to be in force for 2 years for that to happen, as well as so that's the way it is. You'll see a lot of these other ones. I'll get to here in a second that they think there's a 3-year wait, and with fidelity and guarantee, it does. That's their protection package that's offered on the Prosperity Elite 10 and 14. It does double the standard guaranteed withdrawal payments. It will pay for, which is a little different than the American Equity one you saw before. It will pay for home health care as well as assisted living. And you'll see the nursing home a lot of times on other contracts, so it's not really that unique. But no underwriting in this as well, and the 7% growth rate is over 1%, so 1.10. And benefits, the eligibility of this is that benefits must be begun no earlier than the 3rd year of the contract. So it's typically what you see, no more than 3 years is what I've seen though with any of these contracts. The annuitant has to be 60 or older, and like the American Equity one, you must meet 2 out of the 6 ADLs to receive the doubling of the income. And then the Allianz 222. Now this is, like I said, the #1 selling indexed annuity in the industry. No underwriting in this as well. The growth rate is tied to an index, and then you also get 50% added onto it. So if those earlier slides where you saw a 6.5% growth rate as well as a 7%, the 222 it kind of looks like this. So if you had it's tied to an index. So if you could have a Commonly you'll see a Barclays, which is kind of one of their flagship indexes that they offer on that product, as well as the 360. So if your client were to get a 10% return on it, they actually add another 5% onto that. So if you can get a 15% growth rate in that particular year, you're going to have a larger pool of money to draw on. I think most people would agree with that. Income payment does double as well. Nursing home, it will pay for nursing home assisted living as well as hospital care. And it will pay the benefit longer than 5 years. How much longer than 5 years, I don't know, because it's tied to an index. But that's kind of nice thing, is that your income payment, let's say for instance, you had a $10,000 income payment, and of course that would double to 20 because it's tied to an index, and you get a 50% added onto that. It's, the calculations that I've ran is longer than 5 years. So that's one thing to look to, or one reason to take a strong look at this Allianz 222 for that. Start of the income must be, that's the key point too, is that with the 222, you got to wait till the 10th year to start income. So this would be perfect for somebody, I'd say mid-40s to maybe 50 or so, maybe 55, somewhere in there. That way they could wait 10 years, let that cook for a little while, for at least 10 years. Confined, the eligibility as well, is you got to be confined 90 out of the 120 days, consecutive days. And most of these, I didn't put this on the previous slides, but you do have to certify annually on this to make sure that the benefits will continue. And then I'll turn this over to Brian, because he'll talk a little bit more about the life long-term care hybrids and how they differentiate between the annuity. So here you go.
All right, thank you very much, David. Yeah, I'm Brian Lysing back with you here, and I'm going to do an overview of the life insurance-based hybrid products that are out there, and just a quick version of my take on the differences between the annuity and the life-based products. Why would you want to use one over the other? A lot of times you can get more leverage on your dollars if you can put the money into a life insurance-based product, but underwriting is going to be the key issue here. We know a lot of folks wait way too long to get this sort of coverage, and if you wait too long, you have health problems, and then you just become a decline when it comes to a life insurance-based product, or you become so highly table-rated that sometimes it makes more sense to go with the annuity, where you don't have to deal with underwriting at all, or maybe not as much. But looking at the life insurance-based products, I like to think of these in two different categories. We have the single-pay variety, and we have what I call the multi-pay variety. Now, looking at numbers from LIMRA from last year, maybe it was 2013, I think about 75% of the policy sold, or the premium sold, went into the multi-pay variety, and 25% went into the single-pay variety. Now, if folks have just a basic knowledge of these products, what you probably are familiar with are the single-pay products. These are the original hybrids. I remember getting postcards in the mail to attend seminars learning about these back in the year 2000 or 1999, somewhere around there. And with these, the client has a lump sum of money which they move into the product, and they gain a lot of leverage off of that. This is something that really appeals to self-insurers, people that have that large emergency fund out there. Well, the emergency fund's $100,000. What emergency is going to cost you that much money? When you get down to it, it's the high cost of extended care that they're trying to insure against. And a lot of times those dollars really aren't being leveraged as much as they could. We can move them into the single pay variety and put them to work for us. Now, what appeals to, I think, a much broader audience are the multi-pay products. These are a much newer model, and it really is something that is affordable to a lot of folks that just don't have that lump sum sitting around. Not everyone has the extra CDs with $50,000, $100,000, $200,000, $300,000, $400,000 that they can afford to move somewhere else. So we'll stay in those two main categories. To give you an example here on the single pay variety of what kind of leverage you can really get on your dollars, I ran an illustration here with one of our carriers. This happens to be with Genworth and their total living coverage product, and used a male age 60. And for simplicity's sake, I said, what if this guy has $100,000 and he puts it into the TLC? What's that going to give him? And the illustration software spit out a death benefit of just over $200,000. So we've leveraged that $100,000 into $200,000. If nothing else happens and he passes away, his heirs are going to get double the amount they would have received otherwise. Now, what if this gentleman needs to use long-term care sometime in his life? He has a pool of $400,000, a little more than that actually, to draw from for his LTC expenses. So now that $100,000 that was sitting around as, quote, emergency money, we've now turned it into $400,000, and he's much better equipped to take care of those expenses as they come about. The internal workings of these products, when he starts drawing from that $400,000 pool, he's actually drawing down his death benefit as well at the same rate. And once that first, let's say, roughly $200,000 is gone, he's left with the residual death benefit, probably about 10 or 20 grand, and then he can start using the rest of that LTC benefit until that has been used up completely. Now, where are you going to find the money for these sort of products? I mentioned some people have, quote, emergency money laying around somewhere. That's probably in their savings account. Maybe it's in their CD at the bank, and either one of these vehicles, they're earning less than 1%. They're paying taxes on that every year. If that's really what the money is sitting there for, you need to help them move it, because the bank is not doing them any favors with where they have those accounts right now. You also might want to look into your clients' existing life insurance products. If they've got a lot of cash value, maybe in an old whole life contract that is just really cash rich and they're not getting a whole lot of death benefit leverage off of that anymore, we can 1035 exchange those monies into a hybrid type product. You also might want to look at a person's 401k or 403b accounts. One of our carriers does have a mechanism to facilitate moving those qualified funds into another vehicle that can eventually pay for a hybrid life product. And you also might want to look into non-qualified annuities. They're going to have to pay some taxes there. But if they can go through the underwriting, it makes a lot of sense in some cases to leverage those dollars. And as far as single pay products go, there aren't a whole lot out there. We do have a few carriers offering these. And on the universal life side of things, we have MoneyGuard from Lincoln Financial, which is one of the oldest ones out there. A lot of people are very familiar with that contract, get a lot of leverage on those dollars. Genworth has their total living coverage, which was modeled after the MoneyGuard. They hired a bunch of people away from MoneyGuard a few years ago to develop that. And then we also have a simplified issue version through National Western. On the whole life side of things, we have the Asset Care products from State Life, and the Asset Cares 2 and 3. Those are the two products that facilitate movement of either qualified funds or non-qualified annuity money into an annuity with State Life first and foremost, and then it's been drained over 20 years into their 20-pay whole life product, which has this LTC benefit attached to it. So if you're looking for lump sums to move and the clients don't have any money in the bank, look at that 401k. There is a real easy way to move those dollars. Now, we know qualified money is taxable when you do it this way. They spread out that tax hit over 20 years, so a client can actually afford to pay that. And moving on to the multi-pay products, I mentioned earlier, these are actually a lot more common than the single premiums, and this is why I took that same 60-year-old gentleman and I said, well, what would it take on an annually paying basis to give him that same $400,000 pool of money for long-term care? Now, in this case, I actually forget which carrier I used in this example, but the death benefit and the LTC benefit are exactly the same. You'll find that to be very common with the multi-pay type of products. It's one and the same. You start drawing from your LTC benefit, you draw down your death benefit. Now, on the single-pay example, to get that sort of LTC benefit, we needed $100,000, one-time lump sum. What if our client doesn't have that? Maybe he can afford $6,800 a year for the rest of his life to pay in, and he can get a lot of leverage off of those dollars. Now, funding sources for this sort of a product, we could look at a person's existing life insurance policy once again, maybe 1035 exchange existing cash values into something that has some leverage. If they have the old kind of life insurance, the life insurance that only pays when you die, this is a good conversation to have. Let's get you a life insurance policy that can pay you while you're still living. A lot of folks use regular income. Maybe you have a person who is over age 70 and a half, and they're taking their required minimum distributions from a qualified plan, but they aren't using the money. They really don't need it, right? They're taking it because they have to. It's a great source to use, and we can get some leverage out of those dollars. Now, these carriers all vary quite a bit in how they pay out the benefits to the client. And what I've found analyzing all of these is you really get what you pay for. If the client isn't paying a whole lot for a linked benefit product, their benefit payment is maybe a little loose. The more premiums you pay, the more definition you have as far as what kind of LTC benefit you're going to receive. So most of the carriers, though, will pay out the LTC benefit on a monthly basis as a percentage of the face amount. 2% is by far the most common, while some will offer you options for 1 or 3 or maybe even 4%. Some carriers will pay out a benefit as a specified dollar amount. I call this Priceline.com method. You name your price. If you want $5 grand a month, you can have it. If you want $9 grand a month, you can have it. The more you want available per month, the more you're going to pay for that particular rider. A lot of carriers will pay out an annual benefit to the client, but they'll determine the amount at the time of claim. They're going to look at the client's health or lack thereof at that point in time. They're going to look at the time value of money, current interest rates, the face amount, and a whole bunch of things. Your client really isn't going to know exactly what they're going to receive until they file the claim. Now, these types of products cost a lot less than some of the others that I mentioned there. And we do have a couple of carriers, too, that offer this is usually a free rider. It's built into the contract, and they offer your client a one-time benefit, also determined by underwriting and actuarial factors. But it's a big lump sum, maybe up to $250,000. But it's just a one-shot deal, and you can't accelerate anymore after that point in time. Again, those typically cost your client a little bit less. As far as the carriers that offer this, we have about 22 different life insurance carriers here at Financial Brokerage, and I think at last count we have probably 16 of them that offer some form of an LTC or a chronic illness rider, and I'm going to get into the differences right there. There are some other key differences among these policies. Do they reimburse the healthcare provider, or do they pay the client a lump sum? Do you need long-term care continuing education credits to sell it? Which tax code are they using to base their rider on, and is an exam required? And most of the carriers offering these riders offer it on an indemnity model. A few of them, usually those with what we would refer to as the true LTC rider, use the reimbursement model, where they're not going to pay anything more than what your clients can prove expenses for, and a lot of times they're going to be paying directly to the provider. That's a convenience to the client and their family. They don't have to worry about claim filing and payment and all that sort of thing. It's all taken care of for them, and with Genworth Life, but with the assistance of a care coordinator. So that's easy from that perspective. On the indemnity model, with this type of a model, your client is just going to receive an annual or a monthly benefit amount. For the full amount, they don't have to prove expenses. They don't have to collect bills or anything. They're just going to get the money, and it can be used for whatever they want. If you want to pay a family member to provide care, you can do that. If you want to have care in the Bahamas, you can do that. The carrier really doesn't care. As long as you've qualified for the benefits, the money is yours. Very easy to administrate from a carrier standpoint, and gives your client a lot of flexibility as far as who provides care and where that's provided. There are a couple tax codes that govern these types of riders or policies as well. Only the products that use the 7702B tax code can actually market the product as an LTC rider, and that's why you'll see different wording with different carriers. Some will actually call it LTC. Those are using a reimbursement method usually, and on those products you can receive what's called an extension of benefits. That's where the client can receive an amount greater than their death benefit for long-term care purposes. Not everybody has that files under 7702B, and those that do make it available as an additional rider, you pay extra for. But if they haven't filed it as 7702B, it's not available. The 101G tax code, this is actually the more common one that carriers are using. But because of that tax code, they can't actually use the words long-term care. You'll see all sorts of odd rider names, accelerated access solution, chronic accelerated income benefit. I mean, you name it. If it's a tongue twister, they've used it, I guarantee. But there are a lot less restrictions on the use of the proceeds. These are typically paid out on an indemnity basis. Benefit, LTC benefit that is limited to the death benefit. They can't pay out more than the client's death benefit. A lot lower administration costs for the carrier. And the only kicker here really is that the condition the client has must be deemed to be permanent. It can't be something where grandma's broke her hip and we expect her to get better and be walking in 6 months or 9 months. If that's the case, the client will not qualify under the 101G tax code. But another way to look at it too, most folks you see that need long-term care services, they're not getting better. They've gotten to the point where this is just their standard of living at this point in time. They need help. They're going to need help for the rest of their life. There is no recovery. So most folks are going to file claims. The fact that the condition has to be permanent really won't matter at all. Long-term care, continuing education, get this question from time to time, and this actually varies by state. A few of our carriers require you to have that special long-term care continuing ed. If you've already sold traditional long-term care insurance, I guarantee you've already taken this continuing education course in your state. If you haven't, you might want to look into it. If you need hours anyway, this is a great course to take because you need hours anyway, and two, you're going to need it if you want to sell some of the carriers' LTC riders. And a lot of the carriers, though, don't require it. Those are usually the ones that are filing under that 101G tax code that can't use the true term LTC out there. And Fairman Exams, you know what, in a lot of cases, your client does have to go through a full Fairman Exam as part of the normal underwriting process, just like you would for most life insurance policies out there. By doing that, the client can they have an option to receive the best rate possible. If they're preferred plus, they'll give them a preferred plus. You don't have to take a standard if you have a client who's in fantastic shape. So they can get a lot more leverage on their dollars, a lot less cost of insurance coming out of the contract. We do have a few carriers, though, that offer products without that full Fairman Exam, and we have them listed there. And State Life is actually one where they may or may not. It's really determined once the carrier sees the client's information. And as I mentioned before, we have about, I think it comes up to about 16 different carriers with some form of a linked benefit product out there. And something I forgot to mention, I don't want to gloss over this, but there's a few carriers that have a chronic illness benefit available on a term life insurance product of all things. Now, this is something that it's obviously not permanent. It's not going to last the client to the end of their life. But there's 3 of them out there: National Western, Transamerica, American National. Allow some form of acceleration on a term chassis. If you have a younger person who is hurt really bad in a car accident, let's say, and they need some form of care, their term policy can do double duty for them. Or a lot of times we sell term insurance because a client can't afford a permanent policy right now, and our thought is we'll look at converting all or part of that term down the road. Now, you can't convert these LTC riders, but you can set the stage for a sale down the road. If you sell your 45-year-old the term with the LTC benefit attached to it, they're 55 or 65, they're not going to want that benefit to go away, and they're going to make sure that they have some form of LTC or chronic illness rider on their permanent plan down the road. So to wrap everything up here, we know your clients need protection. The high cost of extended care is really the greatest threat to a person's assets as they age, in case they become frail or ill along the way. And as licensed agents, you can offer them protection in any form they prefer. You can choose to do nothing and let them self-insure, and hope we all don't end up paying for them through the welfare program we call Medicaid. Sell them a traditional LTC product. You can get them an annuity product. You can get them a life insurance product. We've never had more options out there for folks than we have today. And these linked benefit products could very well be the answer for a lot of the folks that you get in front of, whether it's an annuity-based product or a life insurance product. And we'll see if we can get to questions here. I mentioned this at the top of the webinar, but we do have all your lines muted, and that's done to cut down on background noise. But you can always type the questions here, and you can do them at the bottom of the control panel on your right. And we'll get to as many of those as we possibly can here, so we figure out how to open up the question panel. And as you're typing your questions there, a little reminder, we're never too busy here at Financial Brokerage to see who else we could help. If you know some other folks out there, whether they're other producers you work with or maybe even your competition, refer them over to us. We have a nice little referral bonus we like to pay out. And if you have folks working in the annuity market, the long-term care market, any insurance market for that matter, by all means, we'd love to talk to them as well and be able to share this information with them. Okay, well, obviously we did a fantastic job this morning, David and I, because I can find no questions out here on the screen. So we're going to pat ourselves on the back for that. But anyway, hope that everybody listening got some great information out of this. I want to thank everybody for taking time out of their day to join us. And as soon as I say that, we have a question out here. Happens every time. Okay, can a client have more than one LTC plan in force? Absolutely, there are no quotas on long-term care plans out there, or the amount of coverage a person can receive. Now, if you're selling them on the annuity side, there may be some suitability questions, and some carriers may allow only so much money in annuities with them or altogether. So on the life insurance side, you're going to have to justify the death benefit. That may be a deciding factor. And then, whereas there's no limit on how many policies a person can have, there are some limits on how much benefit a client can receive per day, per month, per year. The federal government publishes the what's called the per diem limit. I think this year it's $310, maybe $320 per day that a person can be reimbursed for long-term care expenses. Now, if your actual expenses exceed that amount, you're going to have to prove that you really did have expenses. But anything below that, you don't have to prove to the federal government that you had actual expenses. They'll just allow that. So not a limit in coverage, but a limit in benefits that are received. And another question here, do we offer equity services? I'm going to take that to mean, do we work with securities products? And we do not. We are all investment advisor reps over here, so we have the ability to help you if you have if you're a registered rep and you have a client with money moving from a qualified product and moving that into a fixed product over here, but we don't facilitate the sale of those products over here at all at Financial Brokerage. So but that looks like it. So I want to thank everybody for joining us, and feel free to call us too if you have some questions you didn't have a chance to ask this morning, or if there's some clients you've identified that we could look at. We can be reached here at 800-475-5555. And have a great day.